Okay, good morning. Remind you there's a quiz on Friday, and it will cover the material through the end of today's lecture. Okay? And I hope to finish our discussion of hedging by Friday, but we'll see how it goes. And the quiz will be at the end of lecture. So we finished off on Monday with a very simple example of hedging. I'd like to pick up on that. And basically today we'll run through additional examples of hedging. I have an example from the cattle market, and then I'll do some from the financial futures. Remind you that the basic setup is always the same, where I want to see the date, the cash price, the basis, and the futures, and whether you go short or long. So this example was one of an individual that was long in the cash market. So if you're long in the cash market, you always sell futures. If you're short in the cash, you always buy futures to hedge. You do the opposite. That's what hedging is. You take the opposite position, which attempts to neutralize the effect of any price movement. Because if you have equal and opposite positions in two markets, and there's a price movement, well, they'll neutralize one another. So that's the whole idea. So here they were long cash, so they sold futures, and the price fell, and their return was a little bit less than the objective of $7 because, in this case, the basis widened. And let's look at this graph to, yes? You want to sell futures to hedge, right? And if you're short cash, you want to buy futures. And if you sell futures, that's called a short hedge to initiate the hedge. If you're buying futures to initiate, that's called a long hedge. Okay? So the basis is extremely important because we said when you're hedging, you're exchanging price risk for basis risk. You have these opposite positions that are trying to neutralize the price, and that works as long as the prices move up and down together. And the extent to which they do move up and down together is captured by the stability of the basis. If they move in perfect tandem fashion, then the basis doesn't change, right? It's constant. So this graph of price changes hopefully will illustrate why the basis is critical. So this is from the previous example where you sell futures because you're long in the cash market, and the cash price was $7. You sold futures at $8. And so you have opposite positions in these two markets. And then whether the price goes up or it goes down, you don't really care as long as they move more or less together. In this example, both prices went south. They both moved down, which means having sold futures and the price falls, you profit, right? That's how you make money in the futures market. So there's a profit on the top line. On the bottom line, the price is falling. So there's actually an opportunity loss there. So there's a profit and a loss. And where the price settles, when you lift the hedge, that determines the net outcome. And we said that the cash price went down to, was it $6, and the futures was $7.10. So the basis widened by 10 cents a bushel. And there's one point I want to illustrate with this graph, and hopefully you can see it. So if you're short in the futures market on the white line, and you're long on the cash market in the yellow line, and if those lines diverge, okay, and let's keep our example here of a falling market, but it doesn't matter if it's falling or rising. But here, if those lines diverge, then you're making a profit on the top line. If those lines diverge, then your profit will be less than the loss on the bottom. Just think of the extreme example of, suppose that top line was simply flat. So there we'd have a very extreme widening of the basis. So if the top line was flat, you wouldn't make any money in the futures market. You'd lose money in the cash market. So you would really miss the mark in terms of your objective, wouldn't you? The reason being is that the basis widened dramatically. So that's sort of an extreme example. Does that help illustrate the importance of the basis conceptually? Yes, Mary. Okay. I'm sorry.
Why, when it widens,
It's bad? Okay. Yeah. So this is a short hedge. A widening basis with a short hedge is not good. Okay? A narrowing basis is good. We'll look at that later. So the question is, why is a widening basis bad for a short hedge? It's a little bit hard to see here because they both move down, which means that you're making a profit up here and you're experiencing a loss down here. The profit is a little bit less than the loss because the top line doesn't fall by quite as much. Okay, so that's the point I'm trying to make. And to really drive it home, suppose that this top line was just flat. Okay, and so then there would be, the profit would be zero, right? You sold and the price just stayed flat. In other words, the basis became very, very wide. The basis would now be at this level, and so there'd be a loss in the cash and no profit on the futures to offset it. So the changing basis means that a gain in one market is not equal to the loss in the other. And it depends whether you're a short or long hedger as to whether or not a narrowing or widening of the basis is good or bad. So short hedger or narrowing is good. So we could illustrate that again. Okay. Thanks, guys. We could illustrate that again. Let's just take another example here, Mary. So this is a short hedge with a widening basis. But suppose the basis was narrowing. And in that case, let's leave the bottom line flat, and we'll go back to the thick line on top. Okay, so if the bottom line's flat, the yellow line's flat, the thick line on top falls, you're making a profit on the white line on the futures, but the bottom line's flat, so you're not losing anything there. So you're going to end up with much more than $7 because the basis has narrowed. And the extent to which your return exceeds $7 will be exactly equal to the change in the basis. Did you see that last point visually? Yes, Kristen. Okay. The question is, how do you know you're long in the cash market? First of all, there's only two possibilities, right? You're either long or short. So we can narrow it down. But this is very fundamental because when I ask you a question about hedging, you have to determine are you long or short in the cash market. I won't spell it out. Maybe I will in the quiz, but I certainly won't on the midterm. So if you're long in the cash market, typically if we're referring to a commodity like soybeans, then you own the commodity. Okay. Another way of expressing that is, as I said last time, over in the margin you can ask yourself this mental question. The price could either go up or down, and which of those two am I concerned with? So if you're long in the cash market, you're concerned about a fall in the price. You're concerned about a fall in the price. So that's another way to define being long cash. You're concerned about a decline in the price. How do you profit from a decline in the price in the other market, which happens to be the futures market? Well, you all know in a declining market you have to be short to profit. So if you're concerned about a fall in the price in the spot side, then you must sell futures. So the term long cash basically means that you own the commodity, and either it's in your storehouse, okay, it's in your backyard, or it's out in your factory and maybe it's not quite ready for market yet, or it's out in your field and it's not quite harvested yet. But the whole point is if the price falls, you're going to lose, so you're long. I don't know, did that clear anything up for you?
I think it's going to be more tricky when we get into the index.
Yeah, and the financials, sure. That's why we're starting with the most simple example, okay? But we can come back to that question if it's still fuzzy to you. Okay, so let's look at another example. I think the best way to do this is to work through a few examples. You have the midterm from last year. You can also look at last year's final. There's a hedging question on there to prepare for the upcoming midterm. Suggest you look at both exams, actually. So here's another example in the commodity market. And let's consider a cattle rancher. Okay? And again, I'm going to look at a short hedge for the time being, which means that the rancher is long in the cattle market. And the contract size, in live cattle is 40,000 pounds. And roughly speaking, that's about 40 animals. So a finished animal is about 1,000 pounds. So here's an example of where the rancher has approximately 100 head to sell at 1,000 pounds each. Well, already we have a little wrinkle here. And usually I like to add this on an exam where maybe your cash position doesn't exactly match the futures position. The previous example, it matched exactly, right? 5,000 bushels, that's the size of a contract. But in the real world, I mean, what are the chances of that? So in the real world, you have 100 cattle that you're going to sell. So they're out in your back 40, okay? So that means you're long cattle. In other words, if they're out in your back 40 and the price of cattle falls, you're going to lose money. So you're long cattle. You have 100 head. You know the contract specifies 40,000 pounds, which is about 40 head. So you're exactly between 2 and 3 contracts, right? 2 contracts would be 80 head. 3 contracts would be 120. So you have to decide. You know you're long, so you have to sell futures. So we know we have to go short because we're long cash. But do we sell 2 or 3? Well, let's just work through a couple of examples. And if I ask you this on the exam, I won't give you a number that's right between 2 or 3 contracts. It'll be, you round it to the nearest number of contracts, basically. Okay. So I would say you had 110 head. Well, then you go straight to 3 contracts because that's the closest number of contracts. So here you have 100 head. The cash price is 70 cents. The futures is 78. The basis is 8. So we sell 3 February contracts at 78 cents. Again, I'm setting it up exactly the same way. I write down the date. It's November. This is my cash price by basis. That's the futures price. And I want to sell 3 February contracts. I'll be very happy if this is the way you write it on the exam so we can see exactly what you're doing. Okay? Otherwise, we have to guess. And that doesn't work very well. So we've initiated the hedge. This is a short hedge, just like the previous one. So now that you're into it, you hope that the basis narrows. And you've got this added wrinkle. Did I do that right? Okay. Where the number of contracts is slightly different than your underlying cash position. And that may or may not work to your benefit. So the rancher has these cattle. The reason the rancher's hedging is she's probably heard Jake Bernstein on late night TV saying the price of cattle is going down, or who knows. The cattle aren't ready for market anyway. We know that much. They're not quite ready for market. So if they're not ready for market, you can't sell them today. But maybe the price today is attractive to you. The price is 70 cents. So let's focus on that price. 70 cents, that's your target price. The target is not 78 because that's the price in the futures market, and we're not delivering on the futures contract. We're selling in the spot market. So your target is 70 cents. You think that's a good price. The cattle are in the back 40. You can't sell them today because they're not ready, but you can sell them in the futures market. That gives you the flexibility. So you sell 3 contracts at 78. You've got your hedge. It's now January. They're ready for market. Jake was right. The price fell, right? Doesn't it always fall between November and January, according to Jake, right? Nine times out of 10, it falls between November and January. So the price is at 60 cents. The futures at 66, so we have a basis of 6 cents in this example. And now it's January, so you liquidate your hedge. In other words, you market the cattle, you put them in the truck, and you sell them into the market. And you lift your futures position that same day, right? When you unload the cattle at the stockyard, you call your broker and you say, I've just sold my cattle. I've got 60 cents a pound. Can you lift those 3 futures contracts? So you buy back the futures Futures at 66. The basis is now 6 cents, which is good because you're a short hedger. It's narrowed. And so let's work out the final return. Well, you've made 12 cents a pound here. It's 40,000 pounds. That gives you $4,800 a contract times 3 contracts. That's your gain in the futures. Over here on the cash side, whoops, the price fell. So we say there's an opportunity loss because the price has declined by 10 cents. If you had been able to sell the cattle in November, you would have fetched 70, but now you only fetch 60, so there's an opportunity loss of 10 cents a pound. But just be careful now because on the cash side, we only have 100,000 pounds. We don't have 120. That's the futures. So we've got 100,000 pounds. So the opportunity loss is $10,000. The gain on the futures is $14,400. We subtract our brokerage fee, and that gives us $14,175. And this thing in yellow, I will always ask you that question. What's the final price received or the final price paid? Right? If you're short in the cash market, I'll ask you what was your final price paid because you'll be buying whatever it is in the future. Here you're selling whatever it is. So what's the final price received? Well, in this example, it's 74.2 cents a pound. That's the price you get for your cattle in January, which is better than your objective, was 70 cents. And it's a heck of a lot better than the spot price in January, which is only 60 cents. Yes?
The contract was have a delivery point of view or that you like. Can you just have very good cattle in the futures market?
You could, yeah. Yeah, you could. But there'll be some costs of doing that as well, you know. So usually the basis reflects costs of storage, as you know, or transportation costs. So, but absolutely. Feeder cattle doesn't allow delivery, but live cattle does, so sure. And, you know, as you know, a small percentage of hedgers will deliver or accept delivery, but for most hedgers it doesn't make a lot of sense. And, you know, in this case, maybe the ranchers in California and the contract specifies delivery in Illinois, it just doesn't make sense. But if you're close, you can deliver, and if you deliver, then you get your 78 cents, but you have to account for your delivery costs, and I'm really doing that in the basis. Yes?
How do you figure out 74.2 cents a pound?
Okay, good question. Where the heck does that come from? Well, let's start with what we know and try to piece it together, right? Because there's money in different pockets here. So when you drive your cattle to market and you sell them, what price do you receive? Cash price, 60 cents a pound. So you get 60 cents a pound when you market them. And you can call your broker at the same time, right? And you sell, you buy back those contracts, so you reverse your position. And then the next day you check your bank account and how much money has your broker wired into your account as a result of this hedge. What's the profit on the futures trade? Pardon? Yeah, right here, right 14,000. So we've got 60 cents a pound, and that's 100,000 pounds. That's $60,000, and we've got $14,000. So that's $74,000 and change. And so we divide by 100,000. That gives us 74.2 cents a pound. That's one way to do it. Okay, or you could just measure this in pounds, and it's 14 cents a pound. Okay, so in order to calculate the final outcome, you must account for the cash transaction, and if there's a futures profit, well, then you'd want to add that. If you're a short hedger, if you're a long hedger, you want to subtract it. Here we add it to the price we receive for the cattle. So what's the total amount of money that you end up with at the end of the day? Well, you know that it's $74,000 and change. You see that? Okay.
Does the opportunity loss go into any of the other calculations?
Just for your own knowledge, yeah. It's a, it's an economic concept. The reason that the gain exceeds the opportunity loss is because we have 3 contracts, and so we have actually sold 120,000 pounds in futures, so that's a bit unbalanced, plus the basis narrowed. So that's why the 14,000 is greater than the 10. Sure. Sure. I'm going to ask this gentleman here to explain it to you. Can you speak louder, please? Thanks.
Your cash price in January is 60 cents a pound, and then times that by 100,000 pounds, and then you
So that's 60,000. Yeah.
yes, that's 60,000, and you add your gain, which is 14,175, and that gives you
74,000.
number 74,000, and divide that by 100,000 pounds.
Exactly. Thank you. Does that make sense? Okay. So if there's a question like this on the midterm, and there will be, just remember his final step is important. You divide it by the size of your cash position, right? He didn't divide it by 120 because that was on paper. That was what you were doing in the futures. He divided it by his cash position because that's how many cattle he has. He has 100 cattle. And he pulled down $74,000. Each animal's worth is 1,000 pounds, so it's 74 cents. There's a question back there first. Sorry. Yeah, no, go ahead. Then there's one here.
So what information are you going to give us when you give us the question?
The best thing is to look at some of the old exams, but I usually just write a paragraph and I tell you a story. I'll say, there's a rancher who watches television and he has insomnia and he was watching Jake Bernstein. He saw the price of cattle was going to fall. He's got all these cattle. What does he do? Something like that. I'll give you sufficient information that you can put this together, but I'm not going to spell it out like black and white, if you know what I mean. So I'll do my best to tell you a story, and then you have to put it in this format. And have a look at the exams. If it's still not clear, I can give you an example on Friday. Yeah. Pardon me? Oh, where does the 225 come from? I'm sorry, that's the commission fee on 3 contracts. Okay. I'll tell you what that is, yeah. It's usually $50 or $75. Yes?
What's the relevance of adding the basis in that example?
Uh,
You only listed it as from 8 to 6, and you never used it in the calculation.
Well, it's implicit in the calculations, okay? And usually on an exam, I'll ask you, and I have some more examples coming up, but usually on an exam, I'll ask you to tell me how much the basis changed and whether that added or detracted from the hedge. In this case, it changed by 2 cents, and it added to the hedge, but it's implicit in my net return because I'm looking at the opportunity loss here and the gain here, but I haven't spelled it out. You're right. But it is critical. I mean, if the basis had remained at 8 cents, he wouldn't have ended up with 74 cents, right? He basically gained 2 cents a pound on the change in the basis if we adjusted for the differential size in the contracts. Yes?
Yeah, the opportunity loss calculation, is that saying he would have lost 10,000 if he didn't hedge?
Correct. If he didn't hedge, he would have got 60 cents a pound. There was another question here somewhere, I think. This is good. We need to sort out how these hedging examples work. This is very good. Because Kristen's right, it gets more complicated when we start talking about euro dollars or T-bonds, God forbid, or Japanese yen. Okay. So this worked out pretty well for the rancher, right? And he's probably going to be a big fan of Jake's. Yes?
Is the commission based on the per contract?
per contract, round turn, buy and then sell.
Is there a scenario where opportunity loss would be bigger than the gain?
Yes, yeah, the basis goes the wrong way. Because the opportunity loss is what's happening in the cash side. And I've got another example coming up here where we only go to 2 contracts instead of 3. And you'll see that it doesn't work as well, depending which way the market goes. Yes? So the question is are the contracts going to be given? Well, I don't expect you to remember that live cattle is 40,000 pounds. Okay, so I will tell you what the contract size is, or it'll be somewhere in the question. And you know, February doesn't matter too much. I'll give you the month. I don't care that much about the month, but the number of contracts you have to decide, and you have to decide if you're going long or short, right? So this is what you have to choose. Do I go long or short? How many contracts? Okay. Yeah. How many contracts you sell or buy? To answer the question, was that what you were asking me? Yeah. I won't tell you how many contracts to sell or buy in the futures market. You have to decide that based on the contract size and based on your underlying cash position. Okay?
How do you get 3 contracts that wouldn't work out to 2.5?
It would, but there isn't 2.5.
What if you only have 2.5?
Yeah. Well, but we're getting closer to reality here. I mean, you can't walk in a pit and say, I want to sell 2.5, right? You're either selling 2 or 3. Well, I mean, you know, in the futures market, you can sell 100 contracts if you want to, right? So the purpose of this example is to illustrate the fact that in reality, usually the cash doesn't match the futures exactly. So you have to round up or round down, one of the two. And I'm going to, the next slide has 2 contracts instead of 3, and I just want to illustrate the difference. So we could either go with 2 or 3 in this example. It doesn't matter. As I said a few minutes ago in the exam, I won't have it a 2.5. It'll be 2.75 or 2.25. If it's 2.75, you go to 3. If it's 2.25, you go to 2. I always go to the nearest number. Okay? But I put it at 2.5 so I could show you what happens with 2 versus 3 very easily. Okay? How are we doing on time? Okay. Any other questions? This is great. I'm enjoying this. Okay. 2 contracts instead. So this gets at your question. It's a lower number, right? 69 cents, which is not a big surprise because the price fell. And you're making a profit on the futures side. And that position was larger than your cash position, right? So if we have 2, all the other numbers up top are the same. We just have a smaller gain here. It's 9,400 instead of 14,000. So we add the 60,000 to the 9,000, and we get 69 cents and change. That's our return, 69.4 cents a pound. So depending how emphatic Jake was on that late night infomercial, right? If he was really emphatic that the price of cattle was really going to fall and they go down 10 out of 10 times, then maybe you'd sell 3. But if you weren't quite sure whether Jake felt strongly or not, then you might only choose 2, right? So it's just a question of your expectations. And it's also the situation with hedging. I mean, hedging is not exactly the way most textbooks explain it. A lot of it involves sort of your judgment. Is now the time to get in the market? I mean, this rancher has had those cattle in the back 40 for a few months, so he decides to get in November. So the timing and how many contracts you choose all depends on your management skills to some extent. So 2 contracts, you only end up with 69 cents. So let me go back to the sort of graph I started with this morning, and just to drive this home. So here we're long on the cash side, we're short on futures, the basis narrowed. So if the basis narrows and you're making a profit on that white line, on the futures line, and the two lines are converging, well, your profit on the white line is going to be larger than the loss here, right? Because you're making a loss. There's a loss down here, there's a profit down here. And if they're coming together, well, then your profit per pound is going to be larger. So the narrowing of the basis works in favor of a short hedger. Okay. Any questions on this graph? Similar to the one we looked at earlier. All right, well, let's go back to the rancher watching television, and he heard Jake talk about the cattle market. He's got 100 cattle out in the back 40 and decides to sell the cattle in the futures market. But suppose that instead of prices going down, they went up. I mean, who knows, right? And so it's the same idea. The objective was 70 cents a pound going into this. Those numbers on top are the same, and the top line are the same. But instead of going from 70 to 60 cents on the cash side, now we're going from 70 to 80 cents. So prices rise instead of fall. That's all that's changed here, going from November to January. It turns out that Jake was wrong, okay? Which hardly ever happens, but once in a while. So the price went up instead of down. So how does that affect the net outcome? Well, remember when the price fell and you had 3 contracts, it was 74 cents and change, right? Now it's a smaller number. In fact, it's less than your objective. The objective was 70 cents. Instead of 74, you've got 66. So what's going on? Well, because the price rose and you were short and you sold 3 contracts, you're losing more on the futures than they're gaining on the spot. So here on the spot side, prices rose 10 cents. So instead of an opportunity loss, there's an opportunity gain, right, of $10,000, because those cattle are now worth 80 cents a pound. They were worth 70 cents a pound when you initiated the hedge. So there's been a gain there. And normally with hedging, you're willing to forego that gain because you're insuring against a loss, right? We talked about that on Monday. So that doesn't bother you too much. There's a loss on the futures side. The basis widens. Short hedge, that's not good either. So there's a couple of things going on here that worked against you. One, your futures position exceeds the cash, right, by 20,000 pounds. 2, the basis widened. It went from 8 to 9 cents. They're both going to work against this hedge. As a result, your loss in the futures was 13,000, so we end up with 66.5 cents. And you can do the math. Hopefully I worked this out right. It's the same idea. You've got $80,000 in your pocket when you sell the cattle. Instead of the broker wiring you money, you've lost 13,000. You subtract the $13,400 and you end up with 66.5 cents a pound. Yes?
If you have a long hedge, are all these effects of the basis reversed?
Yes. Yeah. And just think of those graphs that I keep throwing up there, okay? If you go back to those graphs, hopefully you can see that. Because then you're long futures, right? And you're short cash. And either they're converging or diverging. Yes?
Yeah, do firms hedge only if their research indicates the market might move against their current position, or do they hedge regardless of what you say?
Question is, do firms hedge routinely, or do they base it on research and sort of time their hedges? And I'll actually talk about that probably on Friday. And the answer is they do both, depending on the firm. There are some very large firms. I've talked about Cargill before in this class. It's the largest privately held firm in the United States. They are a very large commodity merchant, and they routinely hedge. I mean, if they buy 100 head of cattle, they'll sell them in the futures market if they haven't sold them elsewhere. If they've sold soybeans to Japan and they don't own the soybeans, they'll buy them in the Chicago Board of Trade soybean pit. So they routinely hedge because they deal in such large volumes, they can't afford to be unhedged because of the risk. Smaller firms like ranchers or whatever, sure, they'll go unhedged, and in a sense they're playing the market, because if you're unhedged, you're speculating. And if the price of cattle gets really high, as it is today, as many of you know that are trading stock track, I mean, this would be a good time to sell some cattle in the futures market, right? Just like Southwest Airline picked the bottom in the oil market this year. So, you know, if you read between the lines in that article about the airline companies, some of those are selectively hedging. They're not necessarily 100% hedged. Okay. 2 contracts instead of 3, prices go up. So we've got 4 aspects to this example. We started with 3 contracts and prices fell. We went to 2 contracts, prices fell. Now we've got 2 contracts and prices rise. Well, that's great. The yellow number's more than our objective. Okay, it's 71 cents a pound. Basically because your cash position, 100,000 pounds, exceeds your futures position, which is 80. And the cash price is rising, so you're making a profit of 10 cents a pound there. You're losing on the futures side. You're losing because of the widening of the basis, but you've only got 80,000 pounds on the futures side. So it makes sense that your loss in the futures will be less than your opportunity gain. It's a little bit less than the opportunity gain. So the difference, rounding it off, is about 1 cent a pound, right? So if you look at, call this 9,000 and 10,000, the difference is 1 cent a pound on 100,000 pounds. So you end up with 71 cents instead of 70. So you always want to compare the net outcome to your objective in the cash market, okay, which is up here. You tired of asking questions, or do you have one more on this? Sort of all fits together. So you can understand how the change in the basis affects the hedge here, and how the number of contracts affects the hedge, and what happens to the price. You know, was Jake right or wrong? It makes a difference. If Jake was wrong, you want to have 2 contracts. If he was right, you want to have 3. Yes?
So on the midterm, what would be a good general rule to follow when determining how many contracts to buy and sell?
Round to the nearest number of contracts that match the cash position, okay?
Do you want to go over the cash if it wasn't the same, or stay under? Or?
Just round to the nearest number on the cash side, okay? So if we're talking about cattle, it's 40,000 pounds. So if you had 85,000 pounds of, say 85 head of cattle, then just go to 2, okay? Or if you had 75, go to 2, okay? And I'll probably even say round to the nearest number. And if you forget, you can ask me during the exam, okay? But I urge you to practice this a bit too. Look at the questions I ask on the midterm, because it's a little bit different than me standing here telling you what's going on. To have to read it and decide for yourself. But I can't emphasize enough that you should set it up this way, okay? That'll help you to set it up this way. And you know, put your dates in, and you know, I'm telling you a story, so from the story you can fill in the cash prices, you can fill in the futures, you fill in the basis before you even decide if you're going short or long, right? You can fill these numbers all in before you even decide whether you're going short or long, and that's probably a good idea. Get that filled in, and then ask yourself, well, okay, now the price could go up or it could go down. Which of these 2 am I concerned about? And if you're concerned about a fall in the price, well, then I need to be short in the futures market. And that's very helpful when we start talking about currencies or financials, where sometimes, you know, the interest rate's going this way and the price of the asset's going that way. Just ask yourself, am I worried about the price of bonds going up or down? If I'm worried about them rising, I'm going to lose money if they rise, then I must be long in the futures market to offset that loss. Okay. So let's take a break from the examples for a few minutes. There was a question regarding routine versus selective hedging. And this is some of the terminology that we use. So there are basically three types of hedges. There's the arbitrage hedge, the operational hedge, and the anticipatory hedge. The arbitrage hedge involves firms that try to arbitrage between the cash and the futures market. So there are a lot of commercial firms that operate in commodity markets more so than in financial markets, because the financial markets, they're so much more efficient because it's so easy to send something across the wire. Those markets are pretty much arbitrage to the hilt. But you'll find arbitrage opportunities exist in commodity markets on a daily basis. And there are firms out there that profit from that, and that's why the markets are arbitraged, because there are plenty of companies that make money profiting from arbitrage opportunities. So if you're an arbitrage hedger, you look for situations where the basis seems to be unusually wide, for example, and you might buy cash and sell futures, and that activity alone will tend to narrow the basis down. So in that case, you enter into a hedge because of an arbitrage opportunity that you see. Otherwise, you might not be interested in buying the cash, but you see an arbitrage opportunity, and that might initiate some action on your part in the cash market and the futures market, so that leads to the hedge. Operational hedge, that applies to firms that are in the business of regularly buying, selling commodities or processing commodities, and it's also true with financial instruments. And it's just everyday business for you is to be buying or selling commodities or assets. Therefore, you're exposed to price risk on a routine basis. And if you're an operational hedger, you're always fully hedged. And you use the futures market or the options market as a temporary substitute for that forthcoming cash transaction, right? Like the rancher used the market, the futures market, as a temporary substitute for the transaction where he put the cattle in a truck and hauled them to market. The futures sale was a temporary substitute for that activity. And once the rancher carried that activity out, then there was no more reason to be in the futures market, so they got out. So that's an operational hedge if you did that on a routine basis. Every time you have some cattle in the back 40, you sell futures contracts. Anticipatory hedges applies to, as I said, the smaller firms. When I was answering that question, where a lot of the smaller firms will watch the markets, and they'll buy and sell futures contracts and also enter into cash positions based upon their expectations. Okay, so if they have been in the business for years and they believe that the price of cattle is now unbelievably high, well, they would sell 100% of their cattle in the futures market. If they thought the price was too low, they might go unhedged, and that applies to the airlines example too. We saw that some airlines were fully hedged, some were hedged at a lower percentage. Okay. So let me try to squeeze one more example in before I let you go. So there's plenty of hedging in currencies as well, and so we'll get a little more complicated here. And there's a lot of reports out there today regarding impacts of the exchange rate, the changing value of the dollar on firm profitability. Because the dollar is moving so rapidly in these few months, profit or losses for companies that are involved in international transactions are dramatically affected, right? It's not a big surprise. So let's look at an example of foreign expenditures. So if you're buying products overseas and you're paying in the foreign currency, and you're worried about this dollar falling, right? Our president has been overseas telling people that the dollar's too strong, it should fall. And if you have a large purchase coming up from an overseas vendor, and you must pay that vendor in their foreign currency, well, that should make you a little bit nervous, right? If you think your dollar is going to fall by 20%, and you're agreeing today to purchase a product in 2004 for a large number of foreign currency units, then you should be a little bit nervous about that transaction. So what I'm saying is when foreign expenditures are made after the dollar's fallen, then the cost in US dollars is going to rise, right? Obviously. So if you promise someone you're going to buy them a new BMW next summer, and the dollar is 20% lower then, well, the carry through in that promise is going to cost you a lot more dollars. So a more realistic example, I guess, is a firm buying some computer parts from Japan. So this all takes time, right? I mean, this is the real world. You don't pick up the phone and say, I want some parts, and they show up tomorrow morning. It just doesn't happen that way. So you're ordering some components from Japan, and the dollar cost today is $100,000 if you look at today's spot exchange rate. So you're running a business in California. Perhaps you're assembling computers, whatever you're doing. You need these components. You know where you can obtain them. It's going to take a while for them to be manufactured and shipped to you. If you bought them today and paid in at today's exchange rate, then it would be $100,000. And let's suppose that these parts are actually going to cost 13 million yen. Okay, so you're not paying in dollars, but you know that if you did pay in dollars today, that's what it would cost you. So you're actually paying in March. And in March, they're going to cost you 13 million yen. Okay? And so you're concerned that the yen is going to rise in value, and therefore you have to go long futures. So here's an example of what I might ask you on the midterm, but I won't put it out in bullet points like this. It'll be a bit of a story, right? Your firm that deals in buying and selling products internationally, you're worried about President Bush talking down the dollar. You need to import some computer parts from Japan, and you get a quote today that says, yeah, I'll deliver those parts in March, and by the way, they'll cost you 13 million yen. Okay, fine. How do you hedge your exposure to the exchange rate? So you have to figure out that your concern is that the yen's going to rise in value, and therefore you have to go long in the futures market. Okay. I'm sorry I don't have time to finish, but I'll finish up on Wednesday.